Okay, let's just get right into it. The title of today's explainer, FinTech Barbiecore. I know, it might sound a little out there, but trust me, by the end of this, it is going to make a whole lot of sense. It's really a story about this major vibe shift that's happening right now in the world of financial technology. And that line really gets to the heart of it. We're talking about two huge pink-branded fintech companies that just dropped some very grown-up, very serious earnings. And at the same time, there was this quiet but super powerful regulatory shift. See, this isn't about the hype anymore. It's all about performance.
So how are we going to prove this? Well, we're going to connect the dots between three different stories. There's a huge milestone for buy now, pay later, a really surprising comeback in insurtech, and a subtle but industry-defining update from the SEC. And what you'll see is that each one tells a piece of the exact same story. Fintech is finally coming of age.
All right, so first things first. To really get what's happening, you have to understand that the entire mood, the whole vibe in the industry has changed. That freewheeling, venture-fueled party of 2021, when interest rates were basically zero, yeah, that's definitively over. It's been replaced by a much more sober and, frankly, a much more demanding market. The new rules of the game are just crystal clear. The 2021 playbook, spend whatever it takes to get users, ride a giant wave of hype, that's out. But today's market, the one that's getting ready for 2026, it wants something completely different. A clear path to actually making money, solid unit economics, and real financial discipline.
And that brings us perfectly to our first case study starring the biggest name in buy now, pay later, or BNPL, Klarna. Their recent news just perfectly illustrates this whole shift from hype to fundamentals. This right here is the headline number. Klarna just posted its first ever billion-dollar revenue quarter. Now, to put that into perspective, just a few years ago, that kind of performance was reserved for the old guard, the PayPals of the world. This is a massive psychological milestone for Klarna and really for the entire BNPL sector. And it's not just that one number either. The revenue growth is super strong, they've got a consumer base of over 100 million people, and they're making some serious inroads in the all-important US market. I mean, by any measure you can think of, Klarna is now operating at a truly massive scale. But here's the twist, right? The market didn't exactly pop the champagne. Despite these incredible numbers, the reaction was, it was more cautious, more measured. So why? This line just captures the new reality perfectly. See, scaling a credit business isn't just about big revenue numbers. As Klarna gets bigger, moving into banking and cards and deposits, investors are looking much closer at the kind of boring but absolutely critical details. Funding costs, risk management, loss provisions. The cool factor just isn't enough anymore. They want to see responsible, sustainable growth. So here's the big takeaway with Klarna. The entire conversation has shifted. That quick hit, that dopamine rush of seeing huge user growth, has been replaced by a demand for long-term durability. Can the business model actually withstand economic cycles? That's the question everyone's asking now. Okay, let's move to our second act and see how this theme builds. Because if Klarna's story is all about managing massive scale, Lemonade's story is about proving a really difficult thesis and staging a serious comeback.
Lemonade's journey, it has been a total roller coaster. They went public right at the peak of fintech hype in 2020. But then reality hit hard. You had inflation, major catastrophe losses, and a really tough capital market that just squeezed them. But now they're actually guiding towards profitability. A turnaround that honestly felt almost impossible just a couple of years ago. To understand how they're pulling this off, you have to know this one key metric, the loss ratio. It's actually pretty simple. It's just the money they pay out in claims versus the money they bring in from premiums. And all you need to know is that a lower number is always, always better. And for the first time, Lemonade's is improving a lot. And that improvement is so important because it suggests that their core promise, the whole idea of using artificial intelligence for better, more accurate underwriting, it's actually working. It's moving from a theoretical pitch in an investor deck to a proven reality on their balance sheet. This is insurtech finally earning its tech badge. All right, for our third and final act, we're shifting gears to the foundational plumbing of the entire ecosystem. And this is all about a seemingly boring update from the Securities and Exchange Commission, the SEC, that could have absolutely huge consequences. Now, this might look super technical, but the story is actually simple. Think of it this way. Regulators make financial firms hold a certain amount of capital in reserve against their assets.
Before, if a firm held a stablecoin, regulators basically said, whoa, that's way too risky. You have to hold 100% of its value in reserve, which, made it toxic to own. But now, the SEC is saying for certain stablecoins, that reserve only needs to be 2%. It is a monumental shift from toxic to usable in the eyes of regulators.
So what does this actually mean in the real world? Well, it means broker-dealers can finally hold these assets more comfortably. It paves the way for cleaner, faster settlement using tokens. It lowers the barrier for big institutions to get involved. In short, it helps move crypto from feeling like a regulatory casino game to becoming a legitimate piece of financial infrastructure.
And I just love this quote because it gets right to the core of this final story. Headlines chase the hype, but real, lasting systems are built on boring, reliable plumbing. And this quiet SEC update is a foundational piece of that plumbing being laid for the future of digital assets. So, let's tie all three of these stories together. We've got Klarna, LMND, and a regulatory footnote from the SEC. What do they tell us about the state of fintech right now? Okay, let's bring it all home. Klarna's story taught us that once you get to scale, discipline is now mandatory. LMND's comeback? It's all about profitability, proving that sound underwriting finally matters more than just a good story. And that stablecoin update shows that the core regulatory infrastructure for the next phase is quietly but surely being built. So that whole narrative that fintech is over, it just couldn't be more wrong. It's not dead, it's just entering a new, more mature phase. The focus has shifted away from explosive growth and towards sustainable, profitable, and well-regulated business models. It's less about making a big splash and way more about building something that actually lasts. And that leaves us with one final thought. If this whole period of proving profitability and embracing discipline was the industry's Barbiecore moment, what comes next? What does the more serious, more complex, and maybe even world-changing Oppenheimer phase of financial technology actually look like? That's the question to ponder as we watch this space evolve.